The impact of investors cannot be denied, whether one is talking about the high-powered brokers and their skyscrapers or the home-based day traders. However, how profound is it? Do you think a trend, a trade, or a tweet can actually influence markets? Are investors more powerful than the ocean in terms of creating tides that lift all boats? Or are they simply riders on the waves of market forces? Keep watching as we delve into the intriguing tango of money and choices. Thank you for watching this video, but before we begin, if you could, please take a minute to subscribe to my channel. And if you enjoy this, make sure you hit that like button. Also, if you know someone interested in options, please feel free to share this video with them. Now let's get started. It may appear improbable that one person could wield enough power to influence the S&P 500 index or a specific stock in the massive stock market arena, where more than 35 trillion is constantly moving. However, not everything is black and white. Institutional investors are among the most powerful players in the financial world, wielding large sums of money. The acts of certain financial institutions, such as mutual funds, pension funds, and hedge funds, have a significant impact on the stock market. These financial behemoths have notable impact on the market because they are large enough to buy or sell equities worth tens or hundreds of millions of dollars in a single transaction. From the outside, the stock market may appear to be a perfect meritocracy, with everyone doing their part to make sound decisions based on their knowledge. However, because of the large volumes of trades they make, institutional investors' purchasing and selling tendencies might have a disproportionate impact. They typically operate with a strategy not merely to capitalize on current market conditions, but also to prepare the way for future riches. Based on data from market studies and analysis, their projections can validate or signal a shift in the market's direction, which may inspire new investors to enter the market, boosting its overall effect. However, institutional investors are not the only ones who can affect markets. People can now leave their own imprint because of the internet era's democratization of knowledge and influence. Consider insider sales, in which someone with non-public information about a company may sell or buy shares, potentially causing significant price fluctuations if the market interprets these activities as a signal of the company's health. Legal trades by insiders are closely watched by investors because they can shed light on the company's prospects, even though insider trading is prohibited when based on material, non-public knowledge. Famous figures such as Elon Musk demonstrate how powerful an individual can be. Because of his enormous personal influence, his actions, tweets, and even spontaneous comments have the potential to shake up the financial sector and create significant swings in stock values. Musk's relationship with the stock market shows the ability of important individuals, particularly those with a significant internet following and media presence, to influence market movements in the modern day. When Elon Musk decides to sell any of his Tesla shares, everyone takes note. Aside from the sale itself, the market reacts to conjecture about the reasons for it and what it might signify for the future of a very valuable manufacturer. From investors and media outlets, everyone is watching Musk's every action for hints about prospective strategy changes at Tesla or his other enterprises. Investors may take proactive steps to affect Tesla's stock price even before Musk sells shares just because they expect the sale. Musk has a big impact even outside his own businesses. His views on other technologies, such as cryptocurrencies, have the potential to significantly influence their prices. For example, the market reacted immediately and strongly to his tweets about Dogecoin and Bitcoin. Although astonishing, this kind of power makes one wonder how readily an individual may impact investor mood and the flow of funds, raising concerns about the market stability. In today's economy, there is a dynamic between celebrity status and commercial power, as demonstrated by this occurrence. Musk is able to sidestep the media and financial sector middlemen by engaging directly with the public via his social media accounts. There are numerous interpretations of his tweets, which may be both mysterious and humorous, but the market normally latches on to each 280-character message, interpreting them as signals about his thinking and probable business movements. A new generation of traders looks up to Musk as an example of how to shake things up in the financial markets, driven more by the stories and aspirations presented by company executives than by the cold, hard data of the past. Investors are increasingly looking for long-term value propositions that have the ability to transform the world, and his commitment to causes like clean energy and space exploration resonates with them. Elon Musk is the paradigmatic individual market mover when it comes to market dynamics in the digital era. Because his personal brand is entwined with the performance of his enterprises, his investment decisions and public remarks can create immediate and significant market reactions. The Musk effect is a two-edged sword that demonstrates how powerful people can affect markets, while also emphasizing the perils of a market that is vulnerable to the actions and utterances of a single individual. It's the kind of situation that continues to put a wrench in the well-established market theories that maintain that fundamentals, not individual acts, are the key drivers of price changes. Because of the rise of social investment platforms and online forums, individual traders' combined influence can now compete with or even surpass that of major institutional investors. Online forums like Wall Street Bets are fostering a new way of thinking about and acting on stock market sentiment. These platforms democratize power that was previously held by banks by allowing individual investors to network, share data, and coordinate investment strategies by connecting them in one place. Following the purchase frenzy in shares such as GameStop, the humorous and risk-loving subreddit Wall Street Bets garnered considerable attention. This phenomenon, known as the meme stock boom, highlighted the huge strength of aggregate influence of individual efforts. Certain stock prices soared rapidly in a short period of time as thousands of individual traders, inspired by forum discussions, began purchasing shares and options in specific stocks. These moves frequently contradicted what hedge funds and other institutional investors had done, which was to short these securities. Short squeezes caused extreme price surges and, in some cases, huge losses for institutional short sellers, since short sellers were forced to repurchase shares at higher prices in order to cover their positions. Because the small players were numerically and tactically superior to the big players, the market dynamics were inverted. The GameStop incident shows how public opinion, when amplified by numerous online platforms, can produce abrupt and significant market shifts. These internet communities have a far-reaching impact that goes beyond a single incident. Market sentiment has changed as a result of their actions, becoming more chaotic, unpredictable, and usually unconnected to traditional indicators of financial health and firm success. Discussions in these groups have the ability to quickly gain traction, resulting in market-moving crowd psychology. Because of the echo chamber effect, a well-crafted investment story that gains traction on these platforms may soon become a market-moving force. This burgeoning market strength is hardly a lone player. As it interacts with the traditional market dynamics, it creates a tangled web of impact. Large entities, such as institutional investors, use complex models and analysis, whereas smaller entities, such as individual traders, have access to data and are willing to collaborate. When this tug-of-war escalates and generates additional volatility and unpredictability, market instability and the efficacy of conventional investment strategies are put into doubt. On the other hand, this shift raises questions about the need for regulation and whether the market is genuinely honest. Stock prices, according to the efficient market theory, represent all relevant information. However, the rapid and sometimes irrational price swings caused by online communities may call this premise into question, even though market democratization is generally regarded as a positive development. Furthermore, authorities are still attempting to determine how to address the risk posed by organized manipulation or the propagation of false material via these platforms. Individual traders and institutional investors have a complex interaction of strategy, psychology, and technology. Institutional investors have the ability to influence market movements due to their size and the regularity of significant acquisitions. People's impact can outweigh their smaller financial mark when they gather together are notable CEOs whose every move is observed. This evolving landscape brings market efficiency, justice, and the power dynamic between institutional behemoths and ordinary traders into sharp foreground. As the market undergoes continual transition due to new technologies and evolving regulatory landscapes, the effect of individuals and institutions will undoubtedly be a source of intense intrigue and controversy among market enthusiasts, regulators, and investors. As we swim against the currents of the stock market, keeping an eye on the factors at work is critical. Understanding the power that individual and institutional investors have to affect market pricing can help you develop a more sophisticated approach to risk management and better investing methods. Whether you're a seasoned market observer or just getting started, this knowledge is critical for making informed decisions that can mean the difference between riding the wave of market movements and being caught in the undercurrent. Thanks for watching. If you have any questions or comments, please post them below. And be sure to subscribe and hit that like button. Good luck with your trading.